Wall Street, top investors watching your money this week. Joining me right now is Bull-Tick Capital Markets Chief Strategist Kathryn Rooney Vera, ER Share CEO Joel Schulman, and Michael Lee Strategy Founder Michael Lee. Great to see everybody this morning. Welcome. Happy Monday to all of you. Kathryn, kicking it off with you. A market pointing lower to start the trading week. We are watching this $1.9 trillion stimulus plan make its way through the House this week. Also watching inflation, the yield on the 10-year Treasury hitting its highest level in a year. Goldman Sachs raised its oil forecast to $75 in the third quarter as global demand is outpacing the supply of Brent oil. Your outlook, Kathryn, we've talked about inflation before. Are you worried about all of these things culminating? Certainly it's hitting markets today.
The market is finally pricing in the real risk, which I think is inevitable, Maria, of inflation. Whether it comes in the next 12 months, I think that's unlikely, but investors should, Maria, be positioning today for that outlook, which will probably transpire beyond 12 months' time. We still have a negative output gap in the U.S. economy. So the combination of a surging demand, a resumption of some normalcy, which Fauci says could happen by the fall, and additional multi-trillion dollars in stimuli. On top of it, oil prices surging and demand seemingly inelastic to price increases, I think puts us in a position of heightened inflation. The Fed is not going to move at all, but that just means that it's going to look worse in the 18 to 24-month horizon. Bottom line, Maria, stay long risk assets, hedge your positioning with tips, with gold, hey, even Bitcoin. I think there's a crisis in fiat money on the near-term horizon, crisis in confidence, that is. And I think you need to position also with put options. So there's a wide variety of options to hedge your risk positions. You don't want to get out of the markets because the Fed is still pumping the markets and manipulating the markets, but we certainly want to protect our long positions.
Yeah, but I mean, look at these expectations for the year in terms of the backdrop. The economy is strengthening. Do you buy into this idea that we could see 7% GDP?
Yes, and that's the issue with inflation. Right now, inflation protection is still cheap, or relatively so. The market is increasingly considering the real possibility of an inflationary surge. Again, the Fed is unlikely to move given its widening target. So it's not just a 2% inflation target of full employment. Now the Fed is also considering social justice, climate change. So that to me says, Maria, that even when we hit the 2% core PCE inflation target, the Fed's going to wait to go beyond that. So look, I think we still have to be long markets, but we do have to protect our positions. Economic resurgence is coming. I think there's still a lot of pent-up demand. You can see it in the consumer discretionary ratios versus leverage, which tells me that there's still a lot of pent-up demand. And that combined with fiscal stimulus, with monetary stimulus, with surging oil prices, of course, is inflationary.
All right. It certainly is impacting the broader markets this morning. Great to see everybody. Michael, thank you. Kathryn Rooney Vera, Joel Schulman, and Michael Lee. Great to see you guys this morning. Thank you. Have a good Monday.